So this week, the Federal Reserve is expected to raise its benchmark interest rate for the first time in nearly a decade. It believes that the U.S. economy is really capable of absorbing the negative effects of a rate increase. But some say that's really debatable and that it could really hurt consumers in a big way. The interest rate has been really held at a near zero since the financial crisis, as many of you know, because I'm sure you've been enjoying it if you took out a mortgage at that time. Joining me now to discuss what this change really could mean for you is Joe Krier, president of Krier Wealth Management. Good morning to you, Joe.
Hi, Jen.
All right, I know that we've been looking as one of the factors certainly that the Fed decides upon is based on employment rate. And we saw that the employment rate jump, which is typical, though, during the holidays, the temporary employees. Is that a false sense of security or not? Because it seems like they're poised to do this week.
Yeah, the employment numbers that came out last week were actually a little better than just seasonal employment. There was some conversion of part-time workers to full-time workers. And there was a little bit of a bump in wages, and that's been the real thing. All of this rate cutting and everything goes all the way back to 2008 when all of this stuff was into free fall. Now we have stabilization and some decent recovery going on.
And is that why they're doing this then now? Because, we've heard about this for months. I think I remember the last time you and I talked, they were talking about maybe around May, I believe it was, and it keeps getting pushed back. Of course, what we saw happen globally also was a factor.
Yeah, the hints of this actually go back almost 18 months where they've been talking about it. And, saving the economy from 2008 had multiple parts to it, and low interest rates was kind of the last leg to fall. So, they've been projecting this to the point where it's largely priced into the markets. People are expecting it. They've expected it sooner. And now it's a question of, after they raise rates, what are they going to do next? People will start looking to the next meetings.
All right, so let's talk about that, too, in terms of if they make the decision. Janet Yellen comes out and she says, OK, we're raising interest rates. Everybody's usually watching that press conference and wondering what's going to happen. Maybe investors start panicking. Are we going to see immediate Thursday interest rates going up, let's say mortgage rates or credit card rates? What do you think?
Really depends on the bank and the credit card company. They do have the ability to raise the rates. And a lot of these, let's say you have an adjustable rate mortgage, that's likely pegged to the prime interest rate, which is currently at 3.25. So if the feds go from 0 to 1/4, the prime rate can pretty close to immediately go from 3.25 to 3.5, and it's just a matter of days before credit card companies start raising their rates.
So what does that mean then for somebody who maybe has an adjustable rate, maybe an interest only? Are we talking about a significant jump? Because for us that doesn't seem like much, but I guess it depends on the amount that your house is worth.
Sure,
or your mortgage.
And for an individual facing this, they're going to see their mortgage go up by $20, $50, maybe $100 a month. The bigger effect is when you take $50 out of each household across the country that has a adjustable mortgage. It starts to impact the growth of the economy. So initially, this is something that I think the economy's ready for, and these rates have been a nice vacation for people, but they've been artificially low, and it's really distorting how this economy should work.
Too late to lock in now?
I don't think so, no. You've got probably a year before interest rates go up a full percentage point. So, just a little bit more isn't a big deal. Think about people who 30 years ago were getting mortgages at 19%. Paying 4%, which is the national average now, might go to 4.5% over the next few months. That's still pretty reasonable money.
Joe Krier, thank you very much for being here.